Hey guys, my name is Jonathan and I want to help you know your options so that you can create more margin, more money in your budget and build your wealth. Today, I want to talk to you about what is an IRA, what is the differences between a traditional and Roth IRA, and potentially which one is good for you. If that sounds like good news or something you want to learn about, go ahead and stick with me to the end. So, an individual retirement account, an IRA, is an account that you set up at your financial institution that allows you to save for retirement on a tax-free or tax-deferred basis. This account can allow you to not only participate in the stock market, but can provide you advantages for your money along the way. A traditional and Roth IRA are the two most common that we talk about. There are several others, but that's where we're going to focus our time today. A traditional IRA allows you to put money on a tax-deferred basis. This money should be pre-taxed, meaning you have not taken taxes out of it. So if you're an entrepreneur or if you are a contractor, something of that nature, this is the account you want to typically look at first as an option, because you can contribute before your money is taken taxes out of. If you are at a W-2 employer, you can contribute pre-tax. And what that does is allow you to, number one, contribute more money, and it also gives you a tax deduction towards the end of the year. The other thing about this account is, again, you can contribute $6,000. Once you're 59 and a half, you can contribute an extra $1,000 as a catch-up option. But once you're 70 and a half, you have to mandatorily start withdrawing money from this account. And you can no longer contribute to a traditional IRA. Now, the other option is a Roth IRA. A Roth IRA allows you to grow your money and contribute your money in the same fashion as the traditional IRA. But this money is after tax dollars, and because it's after tax dollars, you don't get a tax deduction, but this money grows tax-free for the long haul. So when you get age 59 and a half, there will be no taxes on your withdrawal, and you can contribute to a Roth IRA forever. There's no age limit to where you have to stop withdrawing for a Roth IRA. Now, with a Roth IRA, you can only contribute to this type of retirement account if you're single and your modified adjusted gross income is $140,000 or less. If you're married, it's $208,000 or less. So these income limits and contribution limits are as of 2021. They typically do rise with the cost of living year after year, but this is, as of 21, the most current data. The Roth IRA will allow you to, because this is after-tax money, withdraw from this account prior to being 59 and a half. You can withdraw the money that you contributed, but you cannot withdraw your contributions until 5 years of your first contribution. That is called the 5-year rule. So, which one should be best for you? Now, a lot of folks actually say, hey, when you're looking at this Roth IRA or traditional IRA, you're trying to decide and make a decision based off where do you think your taxes are going to end up in the future. So, if you make a really, really high income right now, 150, 160, and you're single, a traditional may be likely the way to go, because by the time you get to retirement and of age to withdraw this money, you'll likely be in a lower tax bracket. If you're an entrepreneur and you expect your income to continue growing every year, then you may want to go into the Roth. If you're 19, just starting off, and your income is really low, you want to take advantage of the Roth option. What I typically do and what I would suggest is no matter how you slice it, you're going to probably end up with money in both buckets. And yes, there are rules to get money moved later on the way. But just to get you started, I would say this. If you have the Roth option at your employer and you're able to contribute to a Roth, go ahead and do that. If you're at a tax bracket, and you can look at your recent tax return, if you're at a tax bracket of 24%, or lower, go ahead and contribute to the Roth. If you're at a 30% tax bracket, you may need that traditional 32% tax bracket, that type of thing, the higher income tax bracket. You may want to go ahead and contribute to the traditional IRA because it allows you to save. If you were to contribute the max to your 401k, which is $19,500, this year, that would save you nearly $6,068 in taxes. This can be an advantage of a good benefit. But the importance is to know how these accounts work. The one thing I don't want you to do is I don't want you to take your money that you have already had taxes taken out and you start contributing to a traditional IRA. That would be a big no-no. While you won't get penalized, the fact is you will have paid money and you will pay money on that. You will pay taxes on that money twice, and that's just not efficient. Why would you want to pay the government twice for your money? So I hope you guys enjoyed this video, and I hope it's helpful to help you get clearer on the lines between traditional and Roth IRA and the rules that go with each. If you like this video, go ahead and give it a thumbs up, and I hope to see you guys in the next video.